Welcome to Smart Tech and Finance US channel. Today, we will explore the powerful Relative Strength Index to master your trading strategy. The Relative Strength Index, widely known as RSI, is a fundamental momentum indicator used to identify the current market state. Professional traders rely on this tool to measure the speed and change of price movements across various financial markets around the globe. Originally developed by J. Wells Wilder, this brilliant mathematical formula transforms complex market data into a simple oscillator graph. The RSI operates on a strict scale from 0 to 100, providing a clear visual representation of underlying market. Understanding this simple numeric scale is the first crucial step toward making highly profitable and consistent decisions in your. Let us dive deeper into the specific zones that make this indicator so incredibly valuable for retail and institutional investors. The first critical area to observe is the overbought zone, which occurs whenever the RSI value crosses above the 70 level. When the indicator reaches this high territory, it serves as a strong warning sign that the asset price has surged too quickly. An overbought signal suggests that buyers might be exhausted, and a potential downward price correction could happen in the very near future. However, strong uptrends can stay overbought for extended periods, so you must always exercise caution before blindly opening. On the opposite side of the spectrum, we have the oversold zone, which is triggered when the indicator falls below 30 points. Dropping into this low territory indicates that the asset has experienced a severe decline and might be trading well below its value. This oversold condition often alerts smart traders that a potential bullish reversal or upward bounce is likely preparing to unfold. Just like the overbought region, prices can remain oversold during strong downtrends, meaning patience is absolutely required. Between these two extreme boundaries lies the neutral 50 line, which acts as a fundamental border separating bullish and. When the indicator consistently stays above the 50 mark, it generally confirms that the buyers are maintaining control over the current trend. Conversely, if the line remains trapped below the 50 level, sellers are dominating the market, signaling a continuing downward price. Many successful traders use the 50-line crossover as a secondary confirmation tool to validate their primary entry and exit. Now that we understand the basic zones, let us explore some advanced trading techniques that will significantly elevate your technical analysis. The most powerful and reliable concept in momentum trading is divergence, a phenomenon that often precedes massive and highly profitable. Divergence occurs when the price action on your chart moves in the completely opposite direction of the momentum shown by the indicator. There are two main types of divergence you must master perfectly: regular divergence for trend reversals, and hidden divergence for trend. Regular bullish divergence happens when the price prints a lower low, but the indicator forms a higher low during the same period. This specific pattern reveals that the downward selling pressure is fading quickly, hinting that a strong upward reversal is about to begin. Regular bearish divergence appears when the price reaches a higher high, but the momentum indicator prints a lower high at the time. This bearish signal warns traders that the buying enthusiasm is drying up, and a sudden market drop could occur very shortly thereafter. Spotting these regular divergence patterns early gives you a massive advantage, allowing you to enter trades right before the overall trend changes. Now, let us examine hidden divergence, a slightly more complex concept that helps traders safely join an existing trend after. Hidden bullish divergence appears during a strong uptrend when the price forms a higher low, while the indicator prints a lower low. This hidden pattern suggests that despite a temporary momentum drop, the underlying bullish strength remains incredibly robust and ready to. Conversely, hidden bearish divergence happens in a downtrend when price makes a lower high, but the indicator reaches a new higher high. This indicates that the recent upward bounce was merely a fake trap, and the dominant downward trend will likely resume its course. Mastering both regular and hidden divergence requires significant practice, but it remains one of the highest probability setups. To improve your accuracy, always look for divergence signals occurring precisely when the indicator rests inside extreme overbought. Divergence found in the middle of the chart carries much less weight and often leads to frustrating false signals and unnecessary losses. Another secret technique used by elite professionals is drawing traditional trend lines directly on the momentum oscillator instead of the This little-known method provides an incredible advantage because momentum shifts often break their trend lines well before the actual price. By connecting the peaks and valleys on the indicator panel, you create dynamic support and resistance levels based entirely on market momentum. When the momentum line violently breaks through a descending trend line, it offers an early warning that a bullish price surge is imminent. Similarly, a breakdown below an ascending momentum trend line warns traders to secure their profits before the actual asset value begins to plummet. Combining these momentum trend line breakouts with traditional candlestick patterns creates a highly robust and reliable trading system It is extremely important to remember that no single technical indicator is perfect, and relying solely on one tool is very dangerous. Blindly buying an asset just because the indicator hits the 30 level is a common trap that destroys many beginner trading accounts. In a powerful bearish market, prices can continue crashing downward, while the momentum oscillator remains pinned in the oversold territory. Likewise, shorting a strong bull market simply because the reading crossed 70 will quickly result in devastating losses, and to avoid these fatal mistakes, you must always analyze the broader market context and establish the primary trend before to use moving averages or higher time frame price structures to determine whether the dominant market direction is currently moving upward or pushing. Once the main trend is clearly identified, you should only take signals that align perfectly with that specific overall directional market bias. For instance, during a confirmed uptrend, completely ignore overbought warnings and only focus on buying opportunities when This selective approach filters out the majority of false signals and drastically increases your overall win rate across all your trades. Additionally, combining momentum readings with key support and resistance zones on the price chart creates a formidable strategy for finding. Imagine the price hitting a major historical support level exactly when the momentum oscillator prints a beautiful, regular bullish divergence pattern. This perfect confluence of multiple technical factors provides a high-conviction trade setup with a remarkably excellent risk-to-reward. Another crucial aspect to consider is the time frame you are analyzing, as momentum behaves quite differently across various chart signals generated on a daily or weekly chart carry significantly more weight and reliability than those found on a 5-minute chart. Day traders must be extra cautious, as lower time frames are filled with random market noise that can easily distort the indicator reading. Always align your short-term entries with the longer-term momentum direction to ensure you are swimming with the dominant market tide. Let us review a real-world example to solidify everything we have discussed about this magnificent technical analysis tool so far today. Observe this chart where the asset price has been steadily declining for several weeks, creating a clear and undeniable downward market structure. Suddenly, the price drops to form a massive new low, but our momentum oscillator refuses to follow, printing a significantly higher low. This classic regular bullish divergence occurs exactly as the price touches a major historical support zone, providing our ultimate. A smart trader enters a long position here, placing a tight stop loss just below the recent swing low to protect capital. Within a few days, the selling pressure completely evaporates, and the market explodes upward, rewarding the disciplined trader with mass. This scenario perfectly illustrates why understanding momentum shifts gives you a predictive edge, rather than just reacting to lagging price action. As you integrate this tool into your daily routine, remember to keep your trading charts clean and avoid adding too many indicators. Overcomplicating your analysis often leads to analysis paralysis, where conflicting signals prevent you from pulling the trigger on. Stick to price action, key market levels, and one reliable momentum oscillator to build a consistently profitable and easily. Risk management must always remain your top priority, because even the absolute best technical divergence signals will occasionally. Never risk more than 2% of your total account balance on any single trade, regardless of how perfect the setup appears. By protecting your downside, you ensure survival long enough to let your winning trades grow your personal wealth exponentially over time. Practice drawing trend lines and spotting divergence on historical charts until your eyes can instantly recognize these highly lucrative patterns. The road to trading mastery is a continuous journey of learning, adapting to new conditions, and refining your psychological discipline every day. We hope this comprehensive guide has provided you with access actionable insights to transform your approach and achieve long-term success in trading. Thank you for watching. Please subscribe to Smart Tech and Finance US for more advanced strategies. See you in the next video.